Hello, everyone. My name is Kaylin Wilson, and today I'll be presenting on sensitivity analysis as a tool for capital budgeting and how it helps integrate risk into investment decisions. In this presentation, I will explain the role of financial management, walk through how sensitivity analysis works, and discuss both internal and external methods used to evaluate risk. Finally, I'll show how all of these tools come together to support better capital budgeting decisions. Financial management plays a critical role in guiding an organization's overall success. Its primary goal is to maximize shareholder wealth while maintaining financial stability. So, there are three main functions involved. The first is capital budgeting, which determines where the organization should invest its resources. Second is capital structure, which focuses on how those investments are financed, whether through debt or equity. And lastly is liquidity management, which ensures the company can meet its day to day financial obligations. Financial managers are responsible for setting financial goals, monitoring performances, and making adjustments to ensure the organization stays aligned with its strategic objectives. So, next, we're going to talk about sensitivity analysis, which is a technique used to evaluate how changes in key input variables impact the outcome of a financial model. So, it focuses on important metrics such as net present value or NPV and internal rate of return, also known as IRR. So, by adjusting variables like sales costs or discount rates, managers can see how sensitive a project is to change. So, with this helps us identify which variables possess the greatest risk and allow decision makers to better understand the uncertainties surrounding a project. Ultimately, a sensitivity analysis tests how resilient a project is under different conditions. So next, we're going to talk about quantitative and qualitative steps. Conducting a sensitivity analysis involves both quantitative and qualitative steps. On the quantitative side, the process begins by identifying key variables that affect profitability, such as sales, volume, or pricing, and including costs and discount rates. Then a base case is established using the most likely estimates. After that, one variable is changed at a time while all others remain constant, and NPV or IRR. It is then recalculated to measure the impact. On the qualitative side, managers must also consider the factors like market conditions, competitions, and regulatory changes. These elements require judgment and experience, and they help provide context to the numerical results. Internal risk evaluation methods rely on company data and assumptions to assess potential outcomes. One common method is a scenario analysis, which examines best case, worst case, and most likely situations by changing multiple variables at once. So, break even out analysis helps determine the level of performance needed to avoid losses. And this is extremely important. The payback period measures how long it takes to recover the initial investment. A more advanced method is a Monte Carlo simulation, which ultimately it runs thousands of simulations to generate a range of possible outcomes. This provides a more complete picture of risk by showing the probability distribution of results rather than a single estimate. External methods focus on market conditions and broader economic factors that impact a project. So, one key model is the capital assist pricing model, or better known as CAPM, which estimates expected returns based on systematic risk. So, this risk is measured using beta, which reflects how sensitive an investment is to overall market movements. Another important tool is the risk adjusted discount rate, which adds a premium for projects' specific risk. In addition, factors like inflation, interest rates, and industry trends must be considered as they can significantly influence a project's success. Finally, integrating risk into capital budgeting involves combining both internal and external evaluation methods. Typically, the process begins with sensitivity analysis to identify the most critical variables. Then, tools like scenario analysis or Monte Carlo simulation are used to explore possible outcomes. Finally, the discount rate is adjusted using models like CAPM or by adding risk premiums. So, this layered approach ensures that both quantitative data and qualitative judgments are used together. And in the end, by doing this, organizations can make more informed, accurate, and confident investment decisions. Thank you so much for your time. And if you have any questions, please let me know.